Good afternoon, everybody. It is Monday, December 18th, 2023, and this will be our last show of the year since next Monday is Christmas time, and I'll be busy watching my grandkids open up presents. So, where are we today? Well, we talked about a lot of things this weekend, Shooter and I. We did the major markets weekend update. I encourage you to hear that. And the vaults might open in 2024, which is what I want to focus on for a few minutes before we get into retirement income options. 3 Fed presidents or past presidents in the last 36 hours since the Sunday morning talk shows talk about how, hey, we're not talking about lowering rates yet. We just think we're done raising them, and now we got to figure it out. And I think that's fair. I think that they don't want to talk about how stressed out the banks are because, oh my goodness, don't want to scare people. But we know that there's between $500 billion and $1.5 trillion of distressed commercial real estate debt that the banks hold. Now, we hope it's only $500 billion. I think that's optimistic. I think more likely we're close to $1 trillion of bad debt at the banks. That is why we talked about on Saturday how quantitative tightening will probably be cut in half at some point in late Q1 or Q2, maybe Q3. We'll see if the banks can hold off that long. But we already know that banks are getting back the keys on commercial buildings. And as I talked about with you way back in May, after my trip to San Francisco, it was clear to me that there was a lot of time and pain to go on commercial office real estate at that time. Now, here we are 7 months later, and we're beginning to get the rumblings of more banks that have problems and more debt that we can't find somebody to buy, and buildings that are at 30, 40, 50% occupancy, about 55% on average, which is way below the 65% on average that we saw before COVID. There are keys going back to the banks, and there are not a lot of buyers out there at even 90 cents on the dollar. There's not many buyers at 70 cents on the dollar. You start to get buyers around 50 and 60 cents on the dollar for that debt, and we've already seen deals as low as 30 to 40 cents on the dollar. That means very big haircuts for the banks. What do we know about banks? They need short-term rates to be lower than long-term rates. Otherwise, their business model doesn't work very well. They're paying out too much on deposits and not getting enough on loans. There's not enough spread. At some point in 2024, I don't think it'll be a glide path. I think we are looking at fast and hard reductions in the interest rate when the banks start to cry uncle. When is that? As early as March? I think probably April or May like it was last year, but it could be just a little bit later as well. Now, that would be bad for the market for a hot minute. But when the Fed lowers interest rates and cuts quantitative tightening and does a special facility for the banks to get liquidity, don't call it QE, it's a special facility, read my lips, special facility, it's not QE, it's just an extra $500 billion or $1 trillion going onto the Fed balance sheet, not QE, special facility. Remember that. Well, what happens when there's more liquidity because the banks are given money that goes into U.S. Treasuries and funds the budget deficit, and you can't get 5% on your money market anymore? What happens if money markets start paying between 2 and 3% again? Because the Fed funds rate goes down to 3 or 3.5. Remember, the long-term projection for the Fed funds rate is a little under 3. Why? Why is it a little under 3? Because if inflation is between 2 and 3, and the Fed funds rate is between 2 and 3, there's no real interest rate on any of the federal debt that's maturing in the next year or two, because most of the federal debt is financed on 1 and 2 and 5 year notes, some 10-year treasuries. It's really not a lot of it that's financed at 20 and 30 years. There were reasons why we didn't finance more at 20 and 30 years when rates were down to 2.5 on the 20 year. I don't think they were great reasons. I think they missed an opportunity. I think they should have stretched out the debt. The problem with doing that at that time would have been that it put pressure on the people buying the debt. And they didn't want to kill the treasury market. Really, everybody in the world that has always bought treasuries is still buying treasuries, with the exception of China. And what we are finding out, and what they are finding out, is that they'll probably come back to the US Treasury market because their bread is buttered with American butter. So, I'm bullish on the dollar. I'm bullish on America in relative terms. I believe that the world has continued to get better since the Dark Ages. Every statistical measure agrees with me. There is no contrary evidence to that statement, zero. And the United States really does benefit from American exceptionalism, largely tied to our geography, which never gets talked about. If Americans were good at geography, they'd realize that we were just kind of lucky to be here. So when the Fed lowers interest rates, whenever that might be, March, May, July, whatever, there is going to be a wall of money that comes out of money markets and into stocks and real estate. Mainly stocks, because that's the easiest thing for people to do. And if they want real estate, they'll probably buy REITs. You'll notice that was a focus of the punch card dividend stocks article that I put out last night. So you're going to see at some point in 2024 a lot of money come off the sidelines. There's about $2 trillion more in money markets than normal. Right? There's a normal amount that's in money markets, and we're about $2 trillion over that right now. That's a lot of money. $240 billion have come out of stocks this year. How much of that $2 trillion do you think goes into stocks next year? Around half would be typical, maybe 60%. It's over $1 trillion probably going into the stock market next year. That doesn't count increased liquidity from the special facility, don't call it QE. And that doesn't include direct foreign investment, which looks like it's about to start heading up again. A lot of reasons to think that we may get a euphoric peak in stocks in the next year or two. After that, my feelings about the baby boomer retirement crisis that is going to happen eventually. But for the next year or two, this wall of liquidity could hit stocks and REITs alike, which means you want to be mostly long stocks. And for the purpose of our discussion today about option selling, it means that you do not want to write a lot of covered calls. Why? What are the two lessons that we have learned from being stock investors? And it was hard for us to learn this because it's not ingrained in our psychology. Let your winners run, Brandon. That is exactly right. Somebody popped it right up there. I didn't even have to prod. Let your winners run. Don't put a cap on the profits that you can make because, oh my God, I can get 3% more income. You saw in the last couple of weeks, many stocks go up between 10 and 20% just because of the hint of liquidity that could be coming. 50% of the time, actually 51% of the time, after the stock market is up 10%, it goes up 10% more the next year. How's that for, don't try to call it, too high? Another 20% of the time, it ends up being within 5% on either side. And only about 30% does it drop more than 5%. And a lot of those times was after 2 years of double-digit returns. We know that the stock market goes up a little bit more than 3/4 of the time. I think it's like 77%. You want to be a long investor most of the time, and you want to be very long. This is why people like Warren Buffett say, don't bother with bonds. Just be an equity investor. Live with the volatility. When prices go down, just keep on dollar cost averaging in. If you are earning money at work, and I've heard people say this to me, a good friend of mine said this to me. Well, stock market's going down, so I stopped putting money into my 401k. Absolute wrong thing to do. If anything, you should increase what you're putting into your 401k or other investments when the stock market is going down. Why? Because it always goes back up. And what we've learned since the financial crisis is that, hey, QE's for everybody, not just the Japanese. We showed a chart with a shooter in the major markets weekend update that showed the Japanese stock market over the last 20 or 30 years. Yep, big corrections, but up and to the right, right? Up, correction, up, correction, up, correction. Always the ups more than the downs. It's just a function of time. And the central banks saying, hey, in the long run, we're all dead. We can carry stuff on the Fed balance sheet or the Bank of Japan balance sheet forever. Because while the people may die, the country won't. Change the government, change the central bank, change whatever you want. If you take money from your left pocket, put it in your right pocket, charge your right pocket interest, collect the interest in your left pocket, what difference does it make? Japan has proved it over the last 2 generations that big countries and certain small countries can carry debt no sweat. The countries that can't carry debt are the ones that get the screws put to them by the bigger countries. When the European Union, the IMF, World Bank, the United States, China put the screws to emerging markets, they suffer. To the rescue, of course, is Bitcoin, which is allowing emerging markets to band together in a loose affiliation of millionaires, billionaires, and babies. Who said that? So when you take a look at the world, your cognitive dissonance wants to tell you how bad it is. Just remind yourself the world's gotten better since the Dark Ages, generation over generation. Sure, there are a few years at a time that are kind of bad. It happens about every other decade or every third decade. There's the whole 4-generation cycle thing that loosely holds. It's not a rule, it just kind of loosely holds. It has to do with human psychology. Economics, of course, is built on the back of human psychology. You need to wrap your head around the idea that generally the stock market goes up. And remember, what were people calling me in 2018 when I said it would be a rough year, and in 2020 when I said it would be a rough year, and in 2022 when I said it was a rough year? Called me perma bear. I'm not a perma bear. I've never been a perma bear. I laid out forecasts from 2011 to 2016 that all more or less came true, plus or minus a year on the calendar. By holding on to my stocks as long as I could, most of them did pretty well. I cut my stinkers as soon as I realized they were stinkers. I've gotten better at that as I've gotten older, which is the opposite, apparently, than what most people have happened to them. Most people get more stubborn as they get older. I've worked on becoming more introspective and being able to say, well, I might have made a mistake there, or the bad things that could happen are happening. Don't take it personal. It's just business. Get rid of the stinker. You want to ride a donkey or you want to ride a stallion? Now, honestly, those donkey rides down to the bottom of the Grand Canyon look interesting, but I don't want to do it. Give me a fast horse that runs in a straight line. And the reason I say a straight line is because I went around a turn-on horse once and pretty much fell off. Got lucky that I didn't hurt myself. Ride your winners, cut your losers. Your option strategy will wrap around that, and realize that you want to be in the stock market long term. Buffett says 100%. You still have people running around saying 60-40. Your efficient frontier financial planners. If you have one of those guys, fire them, at least on the investments. If they're good at financial planning, fine. But financial planning and investment management are different. If you have a financial planning saying, oh, I think a 60-40 portfolio at 65 years old makes sense, even though you're probably going to live to be around 100, say, you know what? I appreciate you for the financial planning. I like talking to you. Let's get on an hourly schedule for the financial planning, and I'm going to go pick out some other investment managers. Because even if you're 80, you should probably still be 80% in the stock market. And I'll stand by that. Because if you're 80 and have money, you're probably going to leave some of it to the future generations in your family or give it to charity. So you might as well be in equity and make more money. We've only seen one gigantic bull market in bonds. I mean, granted, it lasted 35 years, but it's over with. Bonds are going to be choppy for a very long time, maybe for 2 generations, maybe forever. As far as we're concerned on our investing horizon, forever. Only time I buy bonds is when they're broken. If I can get some sort of capital gain potential out of them too. I don't buy bonds. Oh, look, it's a 7% payout on this bond here from XYZ preferred stock, wacky widget, some bitch sort of thing. I read those articles on Seeking Alpha and around the internet, and I just want to reach out through the computer screen to the author of that and shake the you-know-what out of them. It's Christmas time. I'm trying to swear less. Bonds are crap. Capping your equity gains is generally a bad idea. There's the occasional time to write covered calls. There's even the occasional time to do a buy right, but not many. When I see them, I let you know, maybe 10 or 12 a year. There's just not many times where buying a stock and immediately writing a covered call makes sense. Why? Because you want to use just the basic technical indicators to give you an idea of direction and work from there on top of your fundamental analysis. Something gets legitimately overvalued and overbought, sure, sell it, at least down to a starter position, and then maybe sell a covered call. You see a stock that has huge upside and you want to buy the stock, sell put, and sell a call all at the same time to create a leveraged position. It's called synthetic long. That's fine too. It doesn't happen very often. Been able to do it with a Metis. So let's take a look at a few things here. I put out the punch card dividend stocks for 2024. You will see that I added about a half a dozen new companies, including a couple of REITs and a bank. You know I hate banks, so it took a lot for me to do that. A tech company that's in networks. And I changed the criteria for dividend stocks that I'm only calling it a dividend stock anymore. If it's paying out 3% or more, there's two exceptions. Two double duty stocks, Apple and Microsoft. Their dividends are tiny, but they're two of the 5 strongest companies on the planet, right? Financially. Their dividend rate is increasing at 5.5% per year at Apple and 7.5% a year at Microsoft. Both companies have bought back stock. Apple's bought back more. Both companies benefit from AI. And even though there's antitrust concerns with both, there's relatively easy solutions, or I should say cheap solutions. Very simple to bribe a few politicians, pay a small fine, make a small business adjustment. That's what's coming. And remember, companies like Apple and Google and Microsoft and Amazon are richer than the European Union. So the European Union can come down on them as hard as they want, but if you'll notice, every time they do it, the fine is big, but the change is little. It's the VIG, right? That's the guy in the neighborhood that gives protection, collecting his fee, getting his beak wet, getting a little taste. If you don't think that's what's going on, watch The Sopranos after you've watched The Godfather, after you've watched Casino. That is what's going on. The VIG in Europe is fun to watch for an Italian guy like me because it's so out in the open. If you're watching any of the TV shows out there that are based on older society, Victorian society, or even the Gilded Age, which we've been watching, you kind of get that throaty, ha ha, antitrust. You're going to have to change unless you pay this fine. Over here in the bucket, please. I mean, it's just so out there and right in front of you, hiding in plain sight. Understand these realities. When you buy your stocks, understand who can pay the VIG and who can't. Who has monopoly pricing power? Who's part of the oligopolies? That's where money comes from. You want to be part of an oligopoly. Tightly controlled, not a lot of competition. Buffett talks about this all the time. Go back and read his letters. It's almost every year he talks about it. Where can we get pricing power? So the stocks that I've looked at have pricing power, and they're in big total addressable markets. So if it's a small company, we're hoping that they grab more of that total addressable market. If it's a big company, we want them to be a leader with monopoly pricing power. Remember, monopoly doesn't mean one. It means lack of substitution. That's the official definition. Lack of substitutes. So while there are a lot of car companies out there, the reality is there's no substitute for the card. So what you're looking for are the best car companies because cars aren't going away until they fly. Do you think we still call them cars when they fly? I'm not really sure. Healthcare has monopoly pricing pressure. Why? Because you can't substitute your healthcare for another Big Mac. I mean, you can, but you'll die eventually. I always preferred the quarter pounders with cheese, especially since Pulp Fiction. So take a look at the punch card dividend stocks. The REITs are very interesting right now because next year when the wall of money hits, they should do very well. There is pent-up demand in housing and in industrial and small business. The stinker is office real estate. And I think that storage real estate has been in a peaking process. So I'm not super excited about storage anymore. Now, I wouldn't mind owning a storage facility. I sat on an airplane back from Houston for a couple hours with a woman. Her and her husband had just bought a storage facility near where I want to live. She told me all about it. I think if you can buy a storage facility and you can handle running it, it's probably a great investment at the local level. Buying public storage or extra storage, right? There's been a whole bunch of consolidation in that space. I think they're okay. I don't think you'll lose, but I don't think the gains in the next 10 years will be like they were in the last 10 years. Valuations and stuff, slower growth. Retirement income options last month, the update, go back and review that, and you'll see quite a few nifty things that happened. The new one was just out in the last couple of minutes. So as always, we start with our screening from TradingView, and we take a look at what's oversold and what's overbought. This is 2,904 stocks. These are all the stocks over 300 million in market cap. And I will do a full look-see, the ones with the blue tags are the ones that I have already read up on. I'll take a look at this, see, okay, what's out there? Icon Enterprises. We talked about that. We've been in and out of that one. Veradigm, Petco, Health and Wellness. I don't know nothing about these. But using the weekly chart, they are oversold and starting to see buy signals emerge. So if I was going to learn about something new, I'd take a look at these two. The reason we use relative strength index, it is the absolute easiest thing to use. We don't use the daily because you're not day traders. You're not swing traders for the most part. You use the weekly and the monthly charts to show bigger trends. So let's take a look at Pfizer, which is the one that I'll be talking about today because everybody should probably buy it. That's a dividend investor. Way back here, I told you it would get way down here based primarily on the volume weighted profile. What is that? The volume weighted profile tells you where there's big interest, particularly from big investors, the smart money. Usually the bottom interest bar moves up a level, so you'll see me make my bottom fishing lines kind of in that area. Pfizer just got the bottom fishing. I think this is an overshoot. The company is clearly worth more, so you have a fundamental discount here. So on the fundamental side, Pfizer is cheap. Why do I say that? If you take a look at their historic free cash flow and price to free cash flow over on Stock Rover, which I don't have pulled up, you can see the range. One of the reasons, and it's not that Stock Rover has a bunch of stuff that I use. It has about 4 or 5 things that I use over and over again. Some visualizations in particular, and then the correlations between stocks and ETFs in the market and each other. You can see what the range is for a particular stock price relative to free cash flow, revenues, all that good stuff. Pfizer, their price to free cash flow, among other things, is as low as it ever gets. So unless you think Pfizer's going out of business, this is when you want to start buying it. We've been talking about it for a few weeks now. It's in a bottoming process. The chart looks ugly, but what's going to happen next? It's going to chop around. It's getting some notices from interactive brokers. Anyway, so Pfizer is cheap by pretty much every fundamental measure. You're getting the bottom blow off here. Can it go on a little longer? For sure. We can see selling into the end of the year, I think, almost certainly. I think the Santa rally has mostly happened. I think the next couple of weeks will be sleepy, little in either direction. I like selling puts per the article, and I like taking a position if you're a dividend investor. If you're not a dividend investor, just sell the puts. If you're a dividend investor, buy a little starter position and sell puts. I think you can get up to a half position, which means 2 to 3% of your portfolio. Reason I like Pfizer and Amgen and Gilead and a few others is that AI is going to be very, very good for them. And this is one of the 2 companies that has a really good messenger RNA platform. So Pfizer is beaten down because people are like, well, COVID is down and there's competitors to Viagra and it went generic and blah, blah, blah. Pfizer has a huge pipeline again, huge. They've been reinvesting that money for years that they've been making on ED drugs and mRNA vaccines. They have a big pipeline. The stock's going to turn around. It's going to go back to the 50s. And then we'll see what happens. And you're going to collect a good dividend the entire way. When it gets to the 50s, we'll have to figure out if it's going to break out to new highs or if it's going to make a W shape, an M shape, actually. You'll see that Shooter is actually posting charts in the retirement income options over at Fundamental Trends. A lot of these charts will find their way into articles at both services, but that's what we're doing here. We're really populating the charts here so that you have some real-time updates. We're not goofing around with going through the process of writing a whole article because, frankly, it takes a lot of time. So if we can do the bullet points of the charts over here, we will. I will aggregate them into stocks of the week. Another thing to take a look at when you do your screening is the monthly time interval for relative strength index. So this is monthly. This is a long-term chart versus the weekly, which is intermediate, versus the daily, which is short-term. So if you take a look at a company like Lilly, and it has an RSI of 76 on the monthly, what should that tell you? What does that tell you? Anybody let it roll off your tongue? What does that tell you? RSI of 76 on the monthly time frame, meaning the measurement is at the end of every month. It means that it probably had a huge up rally. Look at that since 2020. So not only is it overbought, but I think it's probably overvalued on a fundamental basis. If you own Lilly and you don't think that it's overvalued, you just think it's overbought, sell a lot of covered calls. If you think it's overvalued, trim back the stock with the idea that you'll buy it back somewhere in here or sell puts somewhere in here. Basic education. Ametis. We've been on Ametis, and I'm going to keep updating until it resolves in one direction or the other. I think that we get a parabolic move in 2024, probably in the first half of the year, so not too far away. Over the last month, I didn't know that. Over the last month, it's up 10%. It must be because measuring from there. And it's just about to hit that spot where my measurement, my parabolic curve tool, says that it should start to move up. We'll see. You can sell the $5 puts on this one. That's in the article. Ametis is my only position that's over a full position, that's substantially over a full position. I think it's a home run stock, but it comes with risk. It's in the energy industry, which is risky. It's got to deal with the government, which is risky. It's got to deal with tax credits. It's got to deal with building stuff. It's not an easy business. That's why I think the upside is so big. So manage your risk with this one, but you have the potential to see it go up 400 or 500% the next year. That's a big deal. So you can build these over at OptionStrat. I have switched to the $19 a month because I didn't use the other tools for the $59 a month or whatever it was. So I just have the basic service, and it just helps me visualize, which is what I want this for, to visualize the trades. So if you sell a $5 February put, you're going to get about 90 cents for that right now per share. You know, that's 18% for a 2-month hold. That's a heck of a annualized return. If the stock goes above 5, which I think it will, it just expires. Now, if you want to get more leverage on your money, you build what's called a synthetic long, and you buy a couple of calls. You don't have to spend all the money that you collect on the premium. But if you say go out to April and buy a $7.50 call, it's going to cost you 50 cents. So every put you sell for 90 cents, you could put 40 cents in your pocket and spend 50 cents on a call. Your downside is that you end up owning Ametis at $5 minus the 40 cents that you kept, so a net cost of $4.60, which is still below today's price. And if it runs, if it goes up for you, you're going to get leverage on your money as soon as it gets past $7.50. Now, if you don't understand what I just said, you're going to have to take some time to understand it. Don't just jump into it. But you can sell a put, use some of the money to buy a call at a further out price because it'll be cheaper and with a little bit more duration so that you don't have to be so perfect. All right, so somebody asked about, well, let's finish up. Somebody asked about SunPower, so let's talk about solar. Solar has had a huge rally. We're primarily using the Invesco Solar ETF. We bought some a month ago and sold puts. The ETF is up 10%. The puts are probably going to expire in January. So the question becomes, what do you do now? Well, it looks like we bottom ticked it, or pretty close. That's why you use monthly and weekly RSI, because they're very effective. When you add volume profile and Elliott wave and everything else, all those confirmations mean something. It usually means that whether you know anything about the fundamentals or not, the market's going in a particular direction because they think they know something about the fundamentals. Or you just have a whole bunch of chasers, or both. Some smart money, some dumb money chasing. Whatever. That's why we get parabolic moves. FOMO kicks in. So with TAN, the price has gone from 45 to 50 on us. I think that you can sell the February 50 puts. As long as you're getting more than 250, I think you're in business. Right now, you're getting 320. I think we're still pretty close to the beginning of the rally in solar. I think it's clearly in the buy the dips phase. And maybe later in the year, later next year, the year after, we get the FOMO rally when the wall of money hits and people realize that there's just no stopping it. Slow it down, can't stop it. Who's the basketball player that quote was about? Was it Michael Jordan or Allen Iverson? You can't stop him. You can only hope to slow him down. That's the deal with solar. Solar is going to be half of global energy supply in the next 20 years, maybe 15. Think that through. It's a upper single digit percentage right now. It's going to 5x in a growing market for energy. You want a piece of that. Ford. We talk about Ford all the time. Why would we sell a cash secured put versus buying the stock and selling a call? This is a good one to do that exercise. So we can buy Ford at 12, basically, and then sell a $12 put, and then sell a $5 call, and you'll get a whopping 0.62 divided by 12, 5%, plus a couple other pennies, 6% maybe. Or you can sell the put at 12, get a few extra pennies, so you're making the same amount of money, and if you buy the stock without encumbering it with a call that limits its upside, you get all the upside and pretty fat dividend. This is why the buy right, and I learned from one of the guys who literally wrote the book on buying a stock and then selling a call on it. The buy right, BUYWRITE, buy right. It's a horrible trade. I fired this guy, the guy who trained me on options. I fired because he kept freaking doing this. He bought stocks that were going down, sold covered calls on them, and we'd have to wait a year or two sometimes to get our money back for that stock to come back. He didn't use technical indicators. So he had a concept that he was able to sell really well, but it didn't work all that great. People fired him every 2 or 3 years. So I made some adjustments. And what I realized is that I could sell a cash secured put, get the same money that I get if I bought the stock and sold a call, same amount of cash is used up. But if the stock got put to me, it was at a low price because I used technical indicators and valuation measures. Time had passed. More people discover the stock. Sometimes I get lucky. I bottom ticket. Other times I wait a few months and I get momentum to the upside. And then I can sell a covered call, maybe when it gets towards 20 and resistance. That is the main spot that you want to sell covered calls, is when a stock hits resistance. Where did you want to sell covered calls on this one? Here, 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 here. Where did you want to sell cash secured puts? Here, 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 here. And in this range, because it's really developing a pretty nifty, right? That's a pretty nifty basing pattern. So if we're right, then nobody is putting value on the Ford real estate that's going to get freed up as they move towards EVs. And if we're right that the fourth industrial revolution technology that they have, that's probably top 10 in the world, is going to enable them to be in other industries, and we're right that 80% of the cars sold in a decade will be EV, not necessarily heavy vehicles. Heavy vehicles might go hydrogen or natural gas even, because that infrastructure is kind of in place. But passenger vehicles, right, anything from your SUV smaller, it's going to pretty much be an EV by 2035. That's a lot of cars to be sold. And what about cash for clunkers? Do you really think that's not coming back at some point? As soon as Miami is half underwater and New York is worried about flooding again, which will be any year now, all the climate change policy will accelerate again. Everybody's just waiting to get clobbered. It doesn't make sense, but it's consistent with human psychology and vested interests. Ford has a ton of upside. Multiple reasons it has upside. It's not just the cars, but the cars are pretty good. All right, we're going to go back to solar, and we're going to talk about SunPower because they updated their 10Q today. And what I've been telling you for a long time, and remember, with SunPower, we sold it near the top because we knew that this energy transition would be lumpy, right? It would take time. Why is SunPower one of the companies that we actually invest in? What makes them special among solar companies? What do they have that almost nobody else has? Same reason that I started looking at Clearway. What do they have behind them? A big freaking oil company backs them. Total and Global Infrastructure Partners own half the company. There's a holding company that's half owned by Total plus one share, and Global Infrastructure Partners that owns half of SunPower. SunPower has about $250 million of debt that is a problem right now, that they're obligated as a matter of law and accounting rules to say, hey, we're violating our covenants. So we have to put out a going concern statement. So the shorts are celebrating right now because the stock is getting beat up and they're going to close their positions. I mean, the dumb ones won't, but the smart ones will. And that'll happen imminently, like today or tomorrow. How do I know that? Because Total is not going to let their money go to zero, period. Dilution is already priced in way more than what they're going to have to raise. Take a look at what the market cap has done. The market cap has dropped 90%, over 90%. So I told you to buy it down here. I told you to trim it up here, and I'm telling you to buy it down here. We started buying it at 9. Well, we sold puts at 9. So we got a couple bucks. So we probably are into it for 7 right now, little teeny tiny positions. I have a client whose biggest position was SunPower. He brought the money over. I sold most of the stock. He didn't say boo about it, so hopefully I look a little bit smart today. Switch this from, well, first of all, this is a monthly chart. This is the RSI. You really can't get more oversold than that on the monthly. So either this company is going out of business, they're going to liquidate, or Papa Warbucks, Daddy Warbucks, is going to come back and say, you know what? We're going to up our stake to 60 or 80%. My guess is 80%. So there will be some dilution, and we will refinance the debt that the banks don't want to refinance. It's chump change to Total, and they want a piece of the American solar market because it's going to be the biggest solar market in the world at some point. Everybody is going to pass the same laws that California has. That's how it happens. Within 10 years of California moving in a direction, the rest of the country moves every single time when it comes to environmental policy, I should say, and fashion and movies and video games. Lots of stuff, actually. SunPower is not going out of business. If you don't want to take that risk, I understand. But you should have never been in the first place if you can't stand the heat. Why'd you come into the kitchen if you didn't want to go around the fire? This company has massive upside. A little bit of dilution is not going to change that. The checkbook behind this company is what matters. They have zero incentive to let this go away. They bought into it in 2011. They've structured it how they want to structure it for the future. SunPower is actually hooked up with Ford and other big companies for distribution. Eventually, you're going to see solar being sold at car dealerships. It's already starting, actually. This is your moment to do a gut check and decide, do I have the intestinal fortitude to actually buy small cap stocks? That's where you're at. If you read the 10Q that came out today, you'll go, they pretty much said that Total is coming to the rescue without saying Total would come to the rescue. I think they even put a date in there, January 26th or something, is when everything will happen by. The only debt that I think has to get refinanced is the debt with Credit Suisse, because I think they need the money. Everybody else will refinance. Total will give them some sort of guarantee. That's it. Big Oil is going to guarantee it. It was the French, my friends. This isn't freaking Exxon or Chevron pulling the rug out from under you. This is the French. You can rely on them. I don't say that tongue in cheek, even though I know it sounds like that. The French, not the British, not the English, have been America's most reliable partner since World War II. Study up. The French have their shit together. They live better lives than us, and they only work 35 hours a week. It's not a bad deal. I think you should be buying it here if you can buy small cap stocks, if you have the stomach for it. If you're looking for something that can go up 10x or more, because solar is going to grow and grow and grow and grow for a couple generations at 20 to 30% clips year over year. Even in the bad years, it's been 20%. In the good years, it's pushed 40. But Trump, who cares? He can't stop nothing. Maybe he keeps himself out of jail. Maybe he gives himself another tax cut. Whatever. He wants to give me a tax cut, that's fine. We'll just pay for it later because in the end, we're all dead. It truly doesn't matter, a lot of this stuff. What matters is the big secular trends, whether or not a company is getting money from the government, which the solar companies all are, whether interest rates are favorable or not favorable, they're moving towards favorable. Whether the fundamentals are deteriorating or improving, SunPower just bottomed out. A lot of the solar companies just bottomed out. And what do the technicals say? I'll go out on a limb and say in 4 weeks, this is already turned up. So what is it today? $4.18 right now. And I know it sniffed the upper threes. I will say that it's over $5 or right at $5 by the January expiration. 20% in 4 weeks. That's my call on SunPower. And I think that over the next 5 or 6 years, it probably gets back up here. And I don't think you should bother selling puts. I think you should just buy it if you can buy it. All right, call it a day. I tried to summarize a lot of stuff. It was kind of ad-libbed, so I hope it made some sense. I will see you on Saturday for another year-end recap. Next week, the stocks of the week will cover the growth stocks, the same way that I just covered the dividend stocks. All right, have a good one.